Hi, welcome. Happy New Year. I hope 2022 is a really good year for you. At the start of every year since 1990, I've spent the first week of the year going through a ritual where I collect data on publicly traded companies and then I slice and dice the data, looking at not just what the market did over the course of the year, but how company practices and financial ratios shifted over the course of a year. Now, last year was a tough year because we were coming off 2020 when COVID beat up the companies across many sectors, decimating earnings. Well, 2021 was a recovery year, so things look a little better this year. But I thought it would make sense to take a look at what 2021 did to companies, both good and bad. This is actually going to be the first of a series of posts I hope to do on the data. But in this one, I want to describe the data, talk a little bit about statistical choices I had to make, and how you can use the data. So let me start with why I started looking at data. One of my favorite movies of all time was Moneyball, and Moneyball came in well into the time that I'd started posting the data, but captured much of what I thought about data. For those of you who've never seen the movie, it's a movie about baseball, about one particular baseball team, the Baseball A's and the Oakland A's, and Billy Beane, who is the general manager of the A's. And what Billy Beane did to revolutionize baseball was to bring in data. Essentially, he took a sport that was built around tradition and gut feeling and intuition, where scouts told you what to do, and he said, let's look at the data. And that now is not just restricted to baseball. It's called sabermetrics, and it's in pretty much every sport. If you wonder why there are so many three-point shots in basketball, it comes from sabermetrics. It's been slower to get into soccer and cricket and football, but it's getting there too. The point is the Moneyball revolution, which started about 20 years ago, is now into every sport. And it's not just sports. In fact, if you look at two of the biggest trends in technology, the first is, of course, big data. Now, some of this is driven by the fact that tech companies collect data about our personal lives, or we choose to share it with them, and they have access to choices we make that would have been private in previous generations. Now, that big data reflects the fact that that data can be collected in one spot and used to make better choices as companies, to come up with new products and services, and to make investment choices. Now, along the way also, you've had this notion that crowds are wiser than experts. This notion of crowd wisdom has become deeply entrenched in how we make choices. Now, it's not just everybody else. If you think about, how you pick a restaurant, you no longer look at restaurant reviews. At least I don't. I look at Yelp reviews. If I want to decide what to watch on my TV screen, I don't look at the New York Times reviews of television. I look at Rotten Tomatoes. We even have cryptocurrencies built around the notion that crowd checking, which is what a blockchain is much more. It's much more robust than having an expert making those choices. In other words, big data and crowd wisdom have become central to how many companies approach business. Now, I have to tell you that I'm both a believer and a skeptic. That sounds like I'm being contradictory. I'm a believer because I believed in big data and crowd wisdom well before those notions were even invented. After all, I have spent much of my professional life in financial markets, which is where data and crowd wisdom had their roots. Because if you think about it, financial markets have always had lots of data. And a market price is the ultimate crowd judgment. That said, though, we've learned in financial markets to be mistrustful of both data and crowds. Mistrustful because we've learned that data doesn't always give us direction. It's not always going to tell us what to do. And we've also discovered that crowds can sometimes make stupid choices, that crowds can be driven by madness. In fact, if I have to provide 4 caveats that you should keep in mind as you look at the data that I'm going to give you, here are the 4. The first is this notion that more data is always better than less data in making decisions is badly placed. I don't think it's true. In fact, I wrote a post about how we're drowning in data. If you ask me what the biggest problem that we face as investors, it's no longer that we don't have enough data, it's we have too much. Data overload is a clear and present danger. And I think one of the skills we will need to navigate the future is to figure out the difference between data and information, what to use and what to throw away. Second, this notion that data will provide you direction, tell you what to do, is deeply set, but I don't know where it comes from, because having worked with data, I can tell you that data pulls in different directions. If you get estimates from the data, it always comes with noise and a standard error. And I think the key discipline you need to kind of navigate your way with data is statistics. And unfortunately, we don't do a very good job teaching statistics, which is one reason I created my quirky version of a statistics class for people to take on my website. The third is that built into many old investment philosophies is this belief in mean reversion, that things always revert back to averages. After all, when you buy low PE ratio stocks, what do you expect them to do? You expect them to go back to the average. Much of investing for the last century has been built on mean reversion. And finally, and of course, mean reversion is a strong force, but it works until it doesn't. When there are structural changes to economies and markets, mean reversion no longer works. And in fact, that might be the reason value investing, at least the old-time version of value investing, hasn't worked very well in this century. Finally, the crowds can be wrong. Just as an aside, I use Rotten Tomatoes to decide what shows to watch. And I made the mistake of trusting Rotten Tomatoes in a show called Money Heist on Netflix. Have you guys watched this show? I made the mistake of watching this show, which is about stupid kidnappers, taking stupid victims and in fact, everybody in this show is insanely stupid. And I wasted hours of my life watching a show I shouldn't have watched. But a reminder again that crowds can be wrong. So as you look at my industry averages for debt ratios or dividend yields across sectors, just because every other company in a sector borrows a lot doesn't mean that borrowing a lot is the right thing for you to do. The consensus can be wrong. So with that lead in, let me talk a little bit about the data that I use for this year's update. When I first started my data analysis in 1990, data was difficult to get, at least without paying hefty amounts of money. And I have access to hundreds of thousands of dollars, and I used to spend $1,000 a year subscribing to Value Line that would each year send me a CD with about 1,700 US companies and maybe 100 variables on each. I was grateful for that data because I could play with those 1,700 companies, and my initial data samples, that's what I used. Over time, my access to data has improved. And I am insanely grateful to all of the raw data providers that I use, from Bloomberg to S&P Capital IQ to FactSet, and I use them all. And that said, I do walk a fine line because I use the data from raw data providers. I have to be careful about the data that I supply on my website, because and I try as hard as I can not to replicate data that's on their website. Almost every variable that you will see me report is a variable that I compute rather than a data that I just pull from a raw data provider. So and it's one reason why you won't see company level data. I provide industry averages, but I don't provide company level data, even though I have it, because that I think would be competing with my own raw data providers. So ready? Let's look at my data for the start of 2022. There were 47,606 firms in my sample this year. Every publicly traded firm that had a market cap greater than 0 was in my sample. I didn't screen for companies. I didn't remove companies that were too small or had missing data. Everything went into my sample. And you see the breakdown of where my companies come from. The biggest slice of my sample is what I call small Asia. And small is just relative here. It's small Asia because it doesn't include India and China, which with 1 billion people plus is large, and Japan. So it's Asia other than India, China, and Japan is 9,408 companies. The next biggest is the US, followed by China, and then you see the rest of the companies. This is just the numbers of companies. Now remember, many of these companies are really small, $5 million, $7 million, $10 million market caps. So I did a different pie chart looking at the market cap of companies in each of these sub-regions. Now you can see the US ends up becoming the dominant slice, $52 trillion of market cap in US companies, giving it close to 40, 42, 43% of the overall world. The next biggest is China, and then EU and the environments. The rest of the world is just tiny slivers that you see there. So it's a global sample, but you can see that the US dominates in market cap terms, but in simple numbers, you can see that, that there are companies from other parts of the world that throw their weight in. Now, if you look at breaking these companies down other dimensions, the most obvious one is to break it down by sector. These are the S&P sectors widely used by many analysts. And you can see the breakdown this year of companies by primary sector. The largest number of companies is actually in the industrial group, 8,223 companies. But in market cap terms, and this shouldn't surprise you, tech companies are almost 19% of the overall market cap of all companies globally. In fact, as a one side note, take a look at energy, down to less than 5% of overall market cap of companies around the world. Now, that's almost halved over the last decade, reflecting how climate change and ESG and all those forces have started to play on fossil fuel companies. Sector groupings are useful, but they're much too broad. So I think it does make sense to break companies down into finer detail, into industry groups. The problem with industry groups, though, is twofold. One is, how do you come up with the groupings? I mean, there are SIC codes, and S&P and other data services do categorize companies by industry group. And the other problem is there are some companies that are difficult to put into a group. I'll give you an example. Apple. 40 years ago, Apple was easy. We put it into the computer hardware business because it made the bulk of its money by selling personal computers. Today, I'm not sure where you'd put Apple. It gets more than 60% of its revenues and profits from the iPhone, a telecommunication device, but also a device through which we get entertainment and services. So that said, though, there is no choice but to break companies into industry groups, and I try. The industry groups I've created reflect both my history. They come from the original groups I used to use my value line data almost 30 years ago, as well as current groupings of companies and industries by services like S&P and Bloomberg and FactSet. So I've created 94 different industry groups, and you can see the numbers of companies I have within each industry group. Now, as you look at my industry averages, some of you are going to be disappointed, either because you want a finer breakdown. In other words, rather than retail, you might want luxury retail. You might wonder why I haven't broken companies down into even finer detail. There are two reasons. One is, if you break these groups down into even finer detail, getting enough companies in each group is going to get more difficult. And the second is, getting the information to make those finer groupings is not always available. So I'm going to stick with these 94 groupings, and every variable that you're going to see, I'm going to give you averages for each of these industry groups. Let's move forward. Let's talk about the data itself that I will be reporting. I don't report much on macroeconomic data because I'm not a macroeconomist, and also there are some great data sources for macroeconomic data. My favorite is the data site maintained by the Federal Reserve in St. Louis called FRED. If you get a chance, visit it because it's an amazing data site, and you can get data going back in time for pretty much any macroeconomic variable, at least relating to the US. The data that I report, which is macroeconomic data, tends to be data that you will not find on other services and which I find necessary in the context of doing corporate finance and valuation. Let me start. Risk premiums. You cannot do financial analysis if you don't know what the price of risk is in the debt and the equity markets. So I do report the latest numbers on both. For the bond market, that's a pretty straightforward number. It's a corporate default spread. I report the most updated default spreads by ratings class on my site. For equity risk premiums, it's trickier. I give you the conventional way in which people estimate equity risk premiums, which is historical data on what stocks, bonds, bills, and real estate have done over the last 92 years. I have a database that goes back to 1928, and I report historical equity risk premiums. But for the last 30 years, I've also argued that those backward-looking estimates, which are static, have to be replaced with forward-looking dynamic estimates. I compute an implied equity risk premium, and you can read up more on that on my site. But I report the start of the 2022 estimate, as well as estimates of that implied premium going back to 1960. I do report on risk-free rates. You're saying I can get the 10-year T-bond rate. You're right, you can get that. But I also report what I call an intrinsic risk-free rate, which I compute by adding up inflation and real growth. And you will, if you track what I do on interest rates, you will see why I make a big deal about that. I report on country equity risk premiums for different countries, which I update every 6 months. And currency, risk-free rates in different currencies, because in the world we live in, you've got to be comfortable working across currencies. Finally, a report on corporate tax rates in different countries. I would love to claim credit for collecting this data, but actually KPMG deserves the credit. I've just taken the data that they have on their side and put it into a spreadsheet which you can download and find out what the marginal corporate tax rate is in Morocco or Pakistan or Canada, if that's what you're interested in. So that's the macroeconomic data. Much of my data, though, is micro. It's company level data on how companies make investment decisions, financing decisions, dividend decisions, risk measures. I won't go through the entire list, but I have as many as 35 different variables, and you can see most of them listed on this table. And as you can see, I've categorized them into risk measures, which are both based on market prices, and they range from conventional betas to more unconventional risk measures, profitability measures, different measures of margins, return measures, accounting returns, cost of funding, cost of equity, debt, and capital, and measures of leverage, dividend policy. And if you're interested in valuation, I do provide pricing multiples, price earnings ratios, PEG ratios, price to book ratios. So every one of these variables, you're going to see me report averages across all companies globally, broken down by the industry groups I showed, as well as averages for 5 regional groupings: the US, Europe, emerging markets, which is a huge group, Japan, and Australia, New Zealand, and Canada. So you'll see both global averages and the averages on all for those 5 regions. And because the emerging market group is so large, I break out Indian and Chinese companies and report the averages for just those companies as well. So if you go to my website, you'll be able to download the Excel spreadsheets with the industry averages for global companies as well as these groupings. Now, a little bit about the data itself. Almost all of the data that I'm using in my latest update was collected in the last week. Now, having said that, though, not all of the data is updated to the same point in time. Let me be specific. If your data is market data, the market data is updated as of right now, December 31st of 2021. So it is updated data. It's the most current data. But a lot of my data is accounting data, and accounting data doesn't get updated every day. It doesn't get updated at the end of every year. In fact, the December 31st, 2021 numbers will not be available to March or April. So what do? I report the most updated numbers I can get. For most of my companies, that is data through September 30th of 2021. If you're on a calendar year or if your quarters end at in March, June, September, and December. So when I compute a number like a trailing PE, here's what I do. I take the current market cap, January 1st, 2022, and I divide by trailing net income, but that trailing net income is through September 30th of 2021. Now, you might think this is inconsistent, but I think it is consistent if you define the way we do these numbers as using the most updated data you can find as of a point in time. And it is realistic, because if you're an investor on January 1st, 2022, the price you observe is the actual price. But the data you have, especially accounting data, is still coming from the most recent financials. Now, in terms of timeliness, this data update is the last one for this year. I will not be doing an update till the start of 2023. Now, some of my variables, like equity risk premiums for the US, I do update on a monthly basis. But the rest of the data is going to be what you see right now. Now, if you want updated data, in the middle of the year, there are other data services that do provide that updated data. But I'm not a data service. I have no desire to be one. So if you decide to use the data on my site, especially later in the year, there are 2 places where I would advise caution. The first is if the market goes through a severe contortion this year, it drops by 35% or 40%, then all of the pricing multiples you're going to see on my database are going to be out of sync. So be careful if the market sees a steep shift. The second scenario is if you see a sector going through a disruption. Oil companies, for instance, if oil prices drop back to $30 a barrel, everything's going to change. So the numbers you're going to see in my data sets are not going to reflect the reality in October or November if oil prices are down to $30. Yeah. Now, final points about estimation choices. When I first started reporting the data, I thought it was going to be pretty straightforward. Hey, how difficult can it be to compute the average PE ratio across broadcasting companies or software companies? I discovered very early on that it's not that straightforward, that there are choices that you make that can change the number that you report. Rather than be opaque, let me give you an example. From the start of 2022, for instance, I've taken a slice of my table for PE ratios, and you're seeing that slice. You're saying, what do I do with this? Let's take a sector, broadcasting, right? This is US broadcasting companies. The second column gives you the number of companies. There are 28 companies. The next three columns give you simple averages of the current PE, the trailing PE, and the forward PE. Simple averages. I take the companies with PE ratios, take a simple average. Now, I could stop there, right? But there are two problems with simple averages. First is, if you have an outlier, this number can be pushed out. So if you look at the auto and truck, you see an average of 996.16. You're saying that's absurd. Not really. It's a simple average. If you have a PE ratio for a company reach 10,000 or 15,000, which can happen if earnings collapses, the simple averages are going to get skewed. Now, you could do statistical games here, but I've computed, I'm going to do an alternative to, no, that's the first problem, is the outliers. There's a second problem. When you have a company with negative earnings, you can't compute the PE ratio. So when you compute simple averages, you remove companies from your sample with negative earnings. You're saying, so what? Well, you create bias anytime you remove companies. So in the second to last column, you see my attempt to deal with both those problems. Here's what I do. I add up the market caps of all 28 companies, including the money-losing companies. I add up the net income, including of the 28 companies, including the money-losing companies. I divide the aggregate market cap by aggregate net income. What does this accomplish? First, it keeps all 28 companies in my sample. Second, it's in a sense a weighted average, right? A big company will be weighted more than a small company. Now, of course, if you have 10 or 15 companies in the broadcasting sector losing money, this number is going to be pushed up, because by including these money-losing companies, I'm reducing the denominator. So in the last column, I compute an aggregate PE ratio using only money-making companies. So in a sense, I'm focusing only on the money-making companies, adding up the market caps and the net income. So think of this as a weighted PE ratio. So if you look at the numbers for broadcasting, they range from 7.05 at the low end to almost 25 at the high end. Now, some of you might push back saying, well, you're trying to obscure the issue. You're trying to confuse us. Not really. I'm trying to tell you the truth, which is when somebody claims that the average PE ratio for a sector is 18, rather than take it as a fact, push back and ask how the average is computed. Because biases can lead you to computing the average in very different ways. Put simply, if I was trying to convince you that a broadcasting company was cheap and I want to use an average, I'm going to go with a high number, which means I'm going to go with forward PEs and a simple average. If on the other hand, I want to convince you the same company is overpriced, I'm going to go with the current PE average, which is very low, or the aggregate market cap to net income. My point is everybody has an agenda, and I want to give you the data to kind of push back or counter that agenda. The other issue I had to deal with in estimation is, since my sample includes all publicly traded companies listed all over the world, many are small, many are in emerging markets, some are in countries where information disclosure laws have holes in them. I had to deal with the fact that there's either missing data or unavailable data. Now, I had two choices. One is to do what some people do, which is to keep reducing the sample to companies that you think have reliable data, which means you end up with a lot of US companies and maybe European companies. But the numbers you're going to get from there will be biased because, again, you're throwing out small emerging market companies. So I tried to have my cake and eat it too. I do report a global average, which includes all companies. And I don't throw companies out just because they're missing data. I include them for at least the variables where they have data. And then I do report averages for the US, Europe. So if you don't trust the global average or the emerging market average because you don't trust the data, go with the US and European averages. So that's a data crunch, and of course, as you know, the reason I make this data public is I would like you to use it, and if you do use the data, you don't need my permission. But and I hope you find it useful in whatever you do. Maybe it'll save you some time. There are only 3 things I would ask of you if you use my data. The first is don't make it a black box. Don't use data from my website or anywhere, any external source that you don't understand. On most of the spreadsheets where I report the data, I also have a worksheet where I report how I compute my numbers. Take a look at how I do that. On some variables like implied equity risk premiums or country risk premiums, you still might be uncertain about how I'm estimating things, but I do have entire papers explaining what I do. I have classes that I've taught on these. Try to understand the data before you use it. Second, if you do decide to use my data in your corporate financial analysis or valuation, I am perfectly okay with it, but please take ownership of your results. In other words, if you find a company to be under or overvalued, say, I found it under or overvalued. Don't say the Damodaran model found it under or overvalued. It's not fair blaming me for your final conclusions. It's ultimately your analysis. My numbers might have helped you, but it's yours to own. And third, if you do have disagreements, with a colleague, with a client, with an adversary, and you're going to use some of my data to back up your case or to undermine them, I'm perfectly okay with it. But please don't bring me in personally into your disagreements, especially if you're in a legal setting. I've always described courts as the place where valuation first principles go to die. It's one reason I will never be an expert witness. And so if you're in court and you're using my data to back up your side, hey, all the more power to you. Just don't bring me into the setting personally. Finally, I'm often asked why I make this data publicly available, and I would love to wear the Mother Teresa garb and act like a saint, but I'm not driven by altruistic motives. I mean, let's face it, I'd have produced almost all of the data you're seeing. I'd have produced anyway. Why? Because I need it. I need it in my teaching. I need it for doing valuations. And having produced it, I don't see the point of hiding it. This isn't some magic, some secret formula. Anybody can do it. So since I have it, I don't see any problem with sharing it. And if there's a hidden agenda here, it is, I think the world still has some imbalances in how much data people have access to. And I think if I can make the investment world a little flatter by making my data available, so be it. So if you find the data useful, I am glad. And as I said, you don't have to thank me. Just pass the sharing along. That's about it. Thank you very much for listening, and I hope you found this session useful.